All right, everyone, welcome back to the channel, which is all about income-oriented investing. I have a very special guest today. I am joined by Dino Rico, President and CEO of Middlefield Funds. You guys already know Middlefield is one of my favorite fund providers, and for me, they are real estate experts. They are my go-to when it comes to my personal real estate exposure. So, Dean, welcome back actually to the channel. How you been?
I'm doing great, Adriano. Thank you very much for having us. It's always great to speak to your audience. I know you've got, lots of investors who are interested in income, and that's really what we do at Middlefield. So it's always happy to be speaking to you about income.
Yeah, you guys have a lot of income. There are more income oriented products, whether it's the ETFs or the closed end funds or the split share funds, of course, which are my personal favorite. So we will get into that. And, you guys are real estate experts. So I have a lot of real estate questions for you. So first of all, our first question, can you give us a general overview of the real estate landscape or the real estate market right now in Canada?
Sure. Well, listen, we know what's happened to inflation and interest rates over the past 18 months. So we've had very rapid move in rates in response to inflation that we hadn't seen in this country for some 40 years. And when people think of real estate with that kind of backdrop, they kind of get quite concerned because they view real estate as being very interest sensitive. And when rates go up, real estate values go down. That's the reaction from a lot of investors. But in fact, when you look at real estate over the past 30 or 40 years, during periods when inflation's been higher than average, real estate actually outperforms because if you're a landlord and you have tenants, interest rates and inflation are usually reflective of a growing economy. And as a result, when your tenants' leases come due, you're able to increase those rents to offset, or in many cases, more than offset the higher inflation or costs in your business. So that's why real estate is often a good hedge against inflation. But we didn't see that last year. And I think the reason for that was that this move in inflation and rates was so rapid, and it was against a backdrop where people were basically thinking we're going in a recession. So again, normally inflation's higher and rates are going higher because the economy is growing. People were thinking the opposite last year. So hence, real estate really sold off. And that's in the public markets, Adriano. But in reality, the fundamentals of the commercial real estate market are as good as we've seen them in years, or dare I say, decades. So to answer your question specifically, the fundamentals in this market continue to be very strong, even with the higher inflation and higher interest rates that we're witnessing over the past 12 to 18 months.
Yeah. Yeah, that makes sense. Every time I log into LinkedIn, I see, Toronto rents soaring and Alberta rents soar. Everything, the rents are going up. Very hard to find apartments or things like that. So do you feel like right now is a great buying opportunity since, interest rate hikes puts pressure on real estate prices, like you said, but it is a good hedge, or real estate typically does well during this type of environment. So what do you think? Do you think it's a good buying opportunity right now?
Yeah, I've been doing this for over 25 years, and coming into 2023 in the publicly listed REIT market, so as distinct from the private real estate market,
The
the
public
publicly
sector is what
listed REIT
I'm
market,
interested in. Yeah.
yeah, the publicly listed REIT market, which I know is your focus,
Yeah.
is about attractively valued, as we've seen, as I say, in dare I say, decades. When
Really?
we looked at the value of the underlying portfolio of these publicly listed REITs, the trading prices for them was at 15 to, in some cases, 25, 30% discounts to those underlying values. So to answer your question, yes, we do think this is a very good time to be invested in these publicly listed REITs. And just to give your audience, a bit more detail, is that real estate is valued often basically taking the cash flow divided by what they call the capitalization rate. The capitalization rate is usually reflecting interest rates generally. So as interest rates have gone higher, the denominator or the capitalization rate goes higher. So that usually drives down the value because the denominator is going higher and the NAV or the value would then be lower. However, what's different is the point I mentioned a few minutes ago is that the underlying fundamentals and the cash flow is actually going up. So what's happening here, the numerator is growing, the denominator is growing, so the actually underlying value is really not moving. So when the trading prices sold off as much as they did in 2022, and the actual value of the real estate basically stayed flat, that created this opportunity that is really so attractive right now relative to, again, what last 10 or 20 years.
Yeah, that makes perfect sense to me. I mean, you could clearly see that, right? So, Middlefield, I mean, you guys have real estate as a core competency, right? This is one of your specialties, and you have two really awesome REIT or real estate products that we're going to talk about now. So, of course, your ETF is MREL, MREL, which used to be named IDR. You renamed it, and it's a very, very high performing REIT ETF that is actually currently beating all three index based REIT ETFs in Canada. I'm talking about VRE from Vanguard, XRE from iShares, ZRE from IBIMO. So MREL is beating all of these despite having a higher management fee, for example, because it is an actively managed fund, right? Not a passively managed fund. So what makes you guys such great REIT pickers?
Well, I think our track record is as strong as it is for a number of reasons. One, it goes back to our founding. Like we've been managing real estate really since the firm came into existence in 1979. I joined in 96, so I've been here for over 25 years now, but real estate's been at the core of what we do. So my original partners, really had a long history when they founded the firm, and I basically learned from them and have just continued that legacy within our company. So there's a long history. In other words, we've been investors through various cycles, and I think that helps us make better long-term investment decisions. And insofar as how we manage the portfolio, so that's our background. But in terms of managing our portfolio,
Mm-hmm.
I think we've created an investment methodology, Adriano, that I think has proven to be pretty successful over time. In that we're big believers in diversification. However, I would describe us more as high conviction managers, not high concentration, but high conviction. So we generally operate funds, including our real estate funds, the ones that you mentioned, with 30 to 40 issuers in them. No one issuer would be more than 5% of the portfolio. So even our highest conviction name, we automatically start trimming once it goes above 5% of the fund. So that really does help control the risk in the portfolio. And then at the other end of the spectrum, we don't own any name with a weighting of less than one. It basically forces us as managers to say, I got to like this company enough so it's at least a 1% weighting. If it's not, you basically got to get rid of it in the portfolio.
Okay.
And I think that methodology has proven to be very successful over time. And then over and above that, once we develop a view, which we do on an ongoing basis, okay, what's the macro backdrop? And when you're thinking about real estate, the various subsectors within the real estate market can actually behave very differently depending on your macro backdrop. So, put differently, industrial can operate very differently from retail, can operate very differently from multifamily, or can operate very differently from office. And once we decide which sectors are best positioned in light of that macro backdrop, we then say, okay, here's the weighting we want in each sector. And then from there, we try to identify the best companies
Mm-hmm.
within each one of those subgroups. And again, that really does go back to our history with some of these companies. I've known these businesses, these management teams, in some cases for 25 years. So we've gotten a high level of comfort with how they're operating their business, how their business is evolving. And I think that's helped us make better REIT selection
Mm-hmm.
REIT selections within each one of these funds. So I think all of that together, Adriano, really helps describe, why we've been able to generate very competitive performance over the history of our investing in real estate.
Yeah, I mean, the holy grail is really to beat the indexes, right? So, I mean, MREL does that with the index-based REIT ETFs in Canada, which is awesome. Another question on MREL, it has a fairly high dividend. I mean, it's I think six and a half, so it's higher than those index REIT ETFs, but it's also higher than what I say is pretty much your only competition, RIT, which is from managed by CI. That this is also an actively managed REIT ETF, but it's much higher yield. So, how does MREL sustain such a significantly higher dividend yield? Is it because you guys focus on really the REITs that keep growing their dividends over time?
Well, that's definitely one factor, Adriano, that we're big believers in equity income. That's really at the core of what we do at Middlefield. And we believe REITs are the best equity income vehicle of any in the market because REITs have proven over decades to grow their dividends. And when you look at dividend growers as opposed to just dividend payers, over any time period, dividend growers outperform all other types of equities, whether they're just dividend payers or growth stocks or you name it. So we try to focus on those REITs that can grow their dividend over time. But aside from that, we want to manage our funds with a view on total returns. So again, our track record shows that yes, we pay out high levels of income, but we're also focused on generating enough total returns to generate positive returns for those investors. So not paying out of capital, if you will. We're generating enough of a total return on the underlying portfolio that we can pay out a high level of income. The other point I would make is that we're also very focused on providing stability of income to those investors. So you look at 2022 when the REIT sector sold off, including MREL, and basically when the MREL trading price goes down, the yield goes higher
Right.
because the underlying fundamentals of the portfolio were very good. We just had this major disconnect that the prices went down, the trading price went down, but the underlying NAV still remained high. And I wasn't prepared to reduce the distribution because we're trying to tell our investors in MREL that this fund will provide stability of distributions or dividends over time. So even though the price went down, assuming that there's no underlying change in the fundamentals of the portfolio, we're not going to reduce the distribution. So I would expect over time, the NAV is going to respond and that distribution, that yield will come down a little bit because the NAV is going to be going higher if this asset class and this fund performs the way I think it will.
Excellent. Excellent. So, now let's talk about RS. So RS is the first ever real estate focused split share fund in Canada. Everyone, my audience knows it's my personal favorite when it comes to real estate. It's my go-to for real estate exposure. And this is actually the number one voted question by my community to ask you, Dean. So RS is currently, or this, if you could confirm this, is RS writing covered calls on the portfolio now? And if not, why not? And what would make you decide, for example, to start writing covered calls on RS?
Sure. So RS has the ability to write calls. And I think the way you framed your question is correct, is that I think there are times when covered writing makes good sense. And there are times where you just want to rely on the ability of the portfolio to generate its income more organically as opposed to writing calls. And it's in the latter situation where we are today. So we're really doing little to no covered writing on the portfolio today because when you write calls, Adriano, as you well know, and I think your audience does as well because they're focused on income, that you're basically collecting a premium from the counterparty, and then potentially if the trading price exceeds the strike price, that stock's
Yeah.
going to get called away. So your potential upside is limited when you're in a covered writing strategy. And as I've been saying over the last few minutes, because we think there's lots of upside that these REITs are trading at such a significant discount to NAV. I'm not prepared to trade away that upside for a premium on writing a call because I can get a good dividend as we speak, plus I want to participate in that upside. So right now, that means that we're doing little to no recovered writing. Now, if the situation changed, and let's say in a year from now that our REITs have had such a good 2023 that they're now trading at a premium to NAV, that's an environment that lends itself more to covered writing because our view is that they're already trading at a higher valuation. I'm not giving up as much upside, and we'll write some calls to generate more income in the portfolio.
Yeah, that makes total sense. And this is why personally I like when fund managers have an active approach instead of or a dynamic approach instead of a systematic approach when it comes to covered call writing. It seems like you guys do that, which is great. So awesome. Another thing I want to ask you for RS. Now, there's a lot of the same REITs as MREL, but it's a little bit more concentrated in Canada. There's less names. Some, a lot of the same names, but there's less of them, and some of them make up a big portion of the portfolio, especially the industrial ones. Some are way over 5%. So what's the premise behind, or the thought process behind why you have a little bit less REITs in RS versus MREL, a little bit more concentration in certain names and in Canada? That's just for my curiosity, to be honest.
Yeah, no, I think it's a great question. So when we launched RS back in 2020, in the fall of 2020, the idea behind it, and it still holds today, that we wanted to provide more concentrated portfolio so that in a split structure, that investors who really focus on splits like yourselves can have a good idea of how this portfolio is going to perform. So it's a little less actively managed, but it's still actively managed, but less actively managed than, say, MREL. And a more concentrated portfolio, as you say, to provide a bit more transparency to investors, because we think that in a split structure, that's what the type of split investor is looking for. So that's what we've really tried to achieve here. So we have more Canadian exposure, although we do have some US names in the fund.
Yeah.
I'm losing one of my favorite names today, which is Summit Industrial Income, which is being taken over by Dream and GIC, who's the sovereign wealth fund out of Singapore. That deal is actually closing today. So I'm losing one of those. And it's given me an opportunity. So actually, today's actually a good day. It's given me an opportunity to buy some other REITs that on a day like today are, selling off. So I think the timing's actually very good.
Great.
But at the end of the day, it's by design been created to provide a bit more clarity and transparency to those investors who are more focused on split share structures, and we think it's designed to do that. And as you say, it is the REIT split. So if investors are looking for a split vehicle with exposure to real estate, here's a more concentrated fund that achieves that for them.
That's excellent. That's great news. Okay, so now I have a few more generalized questions around, split share funds in particular. So in Canada, it seems like, split share funds are closed-end funds, right? So you guys need to do kind of, overnight offerings to issue more shares. But I've also seen this, and I've seen this recently, both ENS and RS have declared that you guys are going to be doing, at the money equity program. So can you explain the difference between what an overnight offering is and this, equity program, which seems to be a little bit more different? It's not like it's issuing shares all in one shot during, overnight, but it's more of a gradual, consistent thing. Can you just explain the difference?
Sure. So let's start with the overnight offering, which is more of a broker syndicated offering. So we would actually work with the major brokers in Canada if we decided to do an overnight offering. And, CIBC and RBC and BMO and Scotia and Canaccord, they would all be involved in that. And it's a bit more of an involved type of deal where we decided we wanted to raise money, that we were trading at a premium. We'd have to put together this syndicate. We'd have to file a prospectus. We'd have to involve the lawyers. Now, it is done on an overnight basis, but then it takes, some some 10 days or so before the offering closes. So we don't get the money until it closes. And we will continue to do that. And that's an efficient way for us to raise capital to put to work in the fund itself. But there's even a more efficient way to do it, and that's by doing these ATMs, which are basically raising money in many cases, Adriano, on a daily basis. And they're smaller increments,
Okay.
but they are basically like a shelf prospectus that we can raise money any day and every day in smaller amounts that we can put to work on a regular basis. So unlike the overnight offering, which if I decided to do it today, I wouldn't get the money for another 10 days. With the ATMs, the at the money, at the market offerings, I could get the money in every day, and again in smaller amounts. But on days like today, where I'm seeing really good value in the market, it's really a benefit to have that in. And I think at the end of the day, they're not exclusionary. In other words, we will continue to do the daily ones in addition to do the overnight offering, which will be in bigger increments. Does that help you understand a little better?
Yeah, no, that's perfect. And just to confirm, I know we had talked about this in our last Q&A, overnight offerings and even this ATM program. This is a good thing for existing shareholders. There's a lot of negative, people think it's negative because usually the overnight offerings, for example, the share price goes down the next day typically, but you guys are always doing this or would always do it when it's trading at a premium. So you're issuing shares higher than the net asset value. So it's accretive to the fund, not dilutive to the fund, right? And these are your words that stuck in my head the last time we spoke.
100%, Adriano.
Is
That's
it the
exactly right.
same thing for the ATM?
You got it.
Okay.
They're always being done on an accretive basis. So all the existing investors are in essence better off when we do these types of things, even on the ATM.
Yeah, it's always a nice event because there's always a lot of chatter, and the next day everyone's like, okay, let's buy some shares because you're getting them 3-4% cheaper. So it's always a nice thing in our community, fun thing. But people who are a bit newer are they kind of really don't understand it, so it's good to clear that up. So ENS, your other split share fund, just renewed. Because you guys have to renew every 5 years because of the preferred shares. It's completely normal. And one question I have is that, in the last 5 years, ENS has done really, really well because Enbridge has done really, really well. Every year, the dividend increases come. So the Class A shareholders really participate in the whole portfolio, which is just Enbridge shares. So if Enbridge raised their dividends in the last 5 years, all that benefit goes to the Class A shareholders, correct? Not the preferred shareholders in those 5 years. Can you just confirm that?
Yeah, so that's correct, Adriano. So the way the fundamentals of the split share structure, and I know you understand it well,
Yeah.
but for your audience is that, effectively what we've done is we've got this portfolio of Enbridge shares, and then we offer our investors in the split structure a preferred share and then the Class A share. And the preferred share benefits from being higher up on the balance sheet and having a first call on all the dividend income that comes in from the underlying portfolio of Enbridge stock. And it is a fixed amount of distribution on those preferred shares. And as you say, the preferred shares also have a limited life. So they expire in the next 3 months or so. So we'll be issuing a new preferred share with a interest coupon that will be reflective of what the market is today. And but below that, you have the Class A shares that don't have a limited life; they're just there. So because the preferred share has a first call on the cash flow that comes in and it's fixed, anything over and above what's payable to the preferred share automatically goes to the Class A. So the way you described it is correct. As Enbridge distributions have increased over the last 5 years, all that excess amount goes to the benefit of the Class A unit holders.
Perfect. That's great news. I just wanted to confirm that. So that leads me to my next question. So split share funds, not only yours, but pretty much all of them, typically on the class, I'm going to focus on the Class A shares now. the dividend is typically set in stone, right? It doesn't really go up and down. So right now on both RS and ENS, I guess we could lump them both in together. It's at $1.56 annually, 13 cents monthly. So what happens if the dividends of the portfolio, either of the REIT portfolio or Enbridge in the next 5 years, the dividend keeps increasing and increasing and increasing? How would you guys translate that benefit to the shareholder? Would you increase the Class A distribution? I know some other split share fund companies, they give a bonus, bonus shares out. That's what Brompton did under SBC. I've seen that because if I remember correctly, I spoke to Rob last year, who manages ENS, and he told me he barely has to write any calls on ENS because the dividend, it's sustaining the dividend. So what would you guys do in a situation where RS or ENS is doing so well, you barely have to write calls? How would you return that to the Class A shareholders?
Yeah, so over the course of the life of both ENS and RS, we've actually have increased the Class A distribution.
That's true, yeah.
And then going forward, it's always going to be subject to what the market conditions are at that time. And then with ENS, it's also going to be, we'll have to take into account what is going to be the coupon that we're going to be paying on the new preferred share that we're going to be issuing once the current preferred share matures in the next few months. So we'll take all those things into consideration. And I think you're correct. It will include, a regular increase, a sustained increase in the distribution on the Class A. It could be in the form of a special, or potentially it would just go into the NAV of the fund and build up the NAV of the fund over time as well. So at this point, we're not in a position to determine how it will be reflected, but it'll take one of those three avenues, and it'll consider tax, it'll consider the coupon that's going to be payable on the pref. All of those factors will come into play once we're faced with that decision at some point, assuming that dividend income from ENS or the underlying ENB or the underlying REIT portfolio continues to go up, which we expect it will over time.
That's great. That's fantastic. Yeah, and for my audience who didn't catch that, the dividend that goes back, that's like a phantom or a non-cash distribution. They're sometimes called that, right? So you're not getting the dividend; it goes back into the fund, which increases the value. So it'll increase the share price.
Yeah, that's correct. So as opposed to going out to our investors in the form of an additional distribution on the Class A, it will just go into the NAV of the fund and actually drive the value of the Class A higher.
Perfect. So, all right. So, I don't want to keep you on. I could talk to you all day and ask you a bunch of questions about split funds and this and that. But you guys recently launched your own YouTube channel. I checked out a few videos. I especially like the ones where you interview the REIT CEOs. Of the big industrial REITs and a lot of these REITs you have in your funds, right? So talk to me a little bit about your content, what we could expect, what kind of content we could expect, and what made you decide to start really focusing a little bit more on the retail investor?
Great question. So, a couple of years ago, as we started to see growth in our split share structure and in our ETFs in particular, and knowing that a lot of that is being driven by retail investors, we made a conscious decision here at the firm to improve how we communicate with those retail investors. So when you think about our website, Adriano, or our YouTube channel, that's really our storefront here at Middlefield. So we want to make sure that we were doing the best job possible in making that storefront experience for our retail investors as informational and as transparent and as user-friendly as possible. So that's why we've developed that YouTube channel, and we've built a new website, which we launched late last year, because we really do want to make sure that people can get access to information in a very transparent, as I say, user-friendly manner. And I think we've achieved that with the website. And our view as well is that we want to provide good quality content to our investors that we think helps them better understand, number one, how we manage money, and number two, why we make the investment decisions that we do. So, as you say, over the course of the last 6, 7, 8 years, we've done many CEO interviews. And we know that retail investors don't often have an opportunity to hear directly from a REIT CEO. So, we wanted to provide that information to those retail investors by publishing content on a fireside Q&A with those REIT CEOs. So last fall, we did it with Kevin Gorey, who's the CEO of, excuse me, of Granite REIT, Mark Kenny, the CEO of the largest multifamily REIT, Cap REIT. And just 2 weeks ago, and we'll be publishing it very shortly on both our YouTube channel as well as on our website, a CEO interview I did with Jonathan Gitlin, who's the CEO of RioCan, one of our largest weightings. And again, it's really designed to provide retail investors an opportunity to hear directly from those CEOs. And we're really bringing on CEOs that we have a high confidence in and trying to express to our clients, our investors, why we have a big weighting in some of those names.
Yeah.
And you can expect more and more of that over time.
Well, that's great. And to my audience, I strongly suggest you subscribe to Middlefield's channel. I'll put the link in the video description below. I especially like the REIT, CEO interviews, because if you go on BNN, it's maybe a couple of minutes. It's very quick. It's very condensed. But this one, you're sitting down with them. You're in person, and it's much more. You get a lot more information, which is great, especially by these guys are the CEOs of really the RioCan and the big REITs that are in your funds, which is very useful to get know what's going on in the real estate landscape. So that's awesome. I think that's a great idea. I've certainly subscribed, and hopefully my viewers subscribe as well. So my last question, I don't want to keep you on, but I know you can't comment legally much on if ever you're thinking about creating a new fund, but 2022 was really a blockbuster year for income investors, income-oriented products, covered call products, leverage covered call products, just an explosion on the Canadian market, which is not really a surprise because I think this style of investing, these types of products typically get more attention during the bad times, right? Because, when there's no growth, you want to get something, you want to get some return another way. So, is Middlefield looking at more products or more covered call products, another split share fund maybe? How are you guys seeing, or how do you view this explosion of income oriented products, and what's next for Middlefield in terms of new products?
Yeah, no, I'm happy to speak to it because we've looked at this recent explosion in income oriented products as being very much in line with who we are and what we do. Again, we're an equity income investor. That's really our raison d'etre. And the fact that more and more investors, since growth has now come out of favor and values come into favor, and a lot of value-oriented companies are more income-oriented, we think that's really playing to what our strengths are. So we look at additional products, Adriano, that we think are a complement to our strengths and a complement to our existing products. So the short answer is yes, we're looking actively at other types of ways, whether they be covered writing funds or some type of other alternative product that we think can provide sustainable and growing levels of income to investors. Now, again, the caveat there is that we're also focused on total returns. We think income is an important component of total returns. So put differently, we're not interested in just providing a product that has a $10 NAV, for example, and pays out high levels of income, and that NAV goes down over time because we're basically paying back income to those investors out of capital. We want to build products here that we think properly represents who we are as an active investor, where we can deliver to investors a combination of NAV growth driven primarily by income, so generating good total returns for investors. So in my view, I think that's really what we're looking to do. And you're right, some of these covered writing strategies, if properly implemented in the right underlying asset class, may be able to achieve those objectives for us. So that's why we're looking at it.
Yeah, and I strongly suggest, I get questions like this all the time from my audience that they like high income, but they're a bit scared with the ones that provide 10, 11, 12. Those are typically covered call. They want more. Some people are really into the dividend growth products that don't use covered calls. And you guys have a really nice lineup. You have a bunch of, you completely rebranded your website, you rebranded or renamed a lot of your funds, and you have quite a few ETFs. You have, let's see, 7 ETFs now that are, that don't write covered calls, but are very dividend growth, or like you say, equity income focused. So you could get some pretty nice yields. So there's MREL, like we talked about, that's really specifically for real estate, but you got a couple of healthcare ones. You have one called MDiv, which I especially like. That's the global dividend ETF, where you could get just the best global dividend stocks around the world without the covered calls. So you'll capture that organic growth. So I strongly suggest to my audience members, check out the lineup, check out Middlefield's new website, and maybe some of these funds could interest you if you want a little bit of income and growth as well. You don't really want those covered calls, which is my focus as an income-oriented investor. But everyone's different. Everyone could find their way or do a hybrid strategy. So Dean, I thank you very much for coming on. Hopefully you'll come on again. I really like, speaking with you, having a real estate expert on, and yeah, congrats on all your success, and hopefully we'll talk soon.
Awesome. Thanks, Adriano. Happy to come on anytime. Thanks so much.
Take care.
Bye-bye.
Properly with yours truly. Also on my website, you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once. And this is really a reference tool or a companion tool to help you build your own portfolio according to your needs and your objectives. It has lists of funds, it has sample portfolios for both Canadian investors and American investors. So make sure to check it out on my website. I actually created a video which shows the product from A to Z, because I don't want you to spend money unless you know exactly what you're getting. So make sure to check that video out on my website. And don't take my word for how good it is. Check out the reviews. There's over 300 of them, and they are all 100% real reviews. So here's some more updated news or recent news. I am now on Blossom, a new investing app designed for investors. I've been using it for a few weeks now. I think it's really, really great. It has a really cool feature where users could actually add and share their portfolios and what they're buying and selling every day. So you could actually link your investing account so it's updated automatically on a daily basis. I recently added my own main portfolio, so you could follow how my portfolio is doing live and what I buy every month. Really, really cool. It's like a mix of Facebook and Twitter, but specifically for investing. So get on your phone, click on the link in the video description below and download the app. It's 100% free, so you too could share your portfolio. Just remember to look for me and follow me. My username is Adrian, PII altogether. Also, I do have a referral link for Questrade, so you could get $50 worth of free stock purchases. This is the Canadian discount broker that I use and I recommend. Unlike Wealthsimple, the other popular discount broker in Canada, you could drip everything you want. It has all the stocks, and it also has dual currency accounts. Very, very convenient if you're buying both Canadian stocks and American stocks. I have a Questrade video, by the way, which gives you a little tour of the features, so make sure to check that out. I also have a referral link for Passive. This is the portfolio tracking tool that I use to consolidate all our accounts to get a nice bird's eye view, so you can consolidate all the information together for easy tracking and stats as well. Also, our Facebook group, Passive Income Investing, is now an invite-only private group. So to join it, you need to click on the link in the video description below and give the group a like to get invited. So we take pride in making this one of the best investing Facebook groups out there with over 13,000 members. There's no scams, there's no spammers, and negative and doomsday people we kicked them out right away. Also, follow us on Instagram if you want a little bit more of our personal journey here in Panama. And lastly, just remember everyone, I am not a licensed or registered financial advisor. This channel is all about my personal investing journey and how I invest to generate high passive income from a diversified portfolio of high yield funds. It's for educational purposes only, so don't forget to do your own research and due diligence. And of course, stay safe everyone, stay healthy, and of course, stay passive. See you next time.